One of the most expensive things that people are spending their money on that's keeping them poor is sitting right outside. Almost everyone must have one. However, there are some exceptions depending on where you live. Can you guess what it is? If you're thinking the automobile, transportation, you nailed it. The automobile is the second leading thing that people spend their money on besides housing. It just so happens that business is looking to boom for the auto repo companies. But why is that? Perhaps because the average payment of a new car in the United States is $716 a month. Now, the average cost of a new car in the United States, and look, I was shocked to hear this, is $48,000. And the average time to pay back that loan is 69 months. And many of the vehicles are being put on 84 months. Now, there are two very important reasons why vehicles are the number one expense people spend their money on besides housing. For one, the cost of the vehicle itself is driven by demand. As long as people are buying vehicles, prices will continue to go up. But there's more to it than that. You see, I don't think if you had the option to spread out the payments over a longer term, that the price of vehicles would be as high. But what do you think? And look, it's not just automobiles. There's four-wheelers, motorcycles, boats, RVs. Think about that. If we had to pay cash for these items, perhaps they may not be as expensive. Or what if we had to pay for these items on a shorter term, say 2 years or 3 years, 24 months, 36 months, as opposed to 5.5 years? Do you think the price would be as high? I don't believe most people could afford it if it wasn't stretched out over such long payments. As mentioned, the average price of a new car in the United States is $48,000. If you put that on 36 months as opposed to 5.5 years, instead of the payment being $716 a month, it would be $1,471 a month. Could you imagine paying that for a vehicle? So look, it just makes logical sense why the price of a vehicle would increase or decrease based on the length of the term that you're actually paying monthly payments. But look, it's not just the length of the time that you had to pay for it. It's the actual cost of the money. You know, that interest rate. When the rates are lower, payments are lower. Payments are lower, more people are purchasing items. More people purchasing items pushes up the demand for an item. Remember supply and demand? If the supply is low, prices go up. If the demand is high, prices go up. However, as mentioned, it's not just automobiles. It's four-wheelers, it's RVs, it's boats, just to name a few. Most people aren't aware that when you see a boat, most boats are financed on 15, 20, even 30 years. The same goes for a motor home that you'll see driving down the road. That motor home oftentimes is financed over 30 years like a home. Now, don't get me wrong, a $200,000 boat or a $200,000 motor home riding down the road financed over 30 years at a decent rate with a decent credit score is still going to run you around $1,400 a month. Now, the benefits to claiming that as a second home is that you get to deduct the interest off your income taxes for the interest that you pay on those items. So that $1,400 a month payment, you may be able to deduct $4,000 to $5,000 a year off your taxes simply because you're able to claim those big ticket items as a second home. But what about houses? What about real estate? What about buying your personal home or investing in real estate? What if you could not finance a $200,000 or $300,000 or even $125,000 property home on 30 years? They most likely wouldn't be as expensive. The interest that we pay has a huge factor when it comes to monthly payments, and monthly payments is a huge factor when it comes to the demand of an item, whether it be a boat, a house, a motorhome, a car. It's all affected by monthly payments. When payments are lower, you buy more, you spend more, and thus prices go up. Now, I've seen this over the years in real estate. When the interest is low, it becomes more affordable. As it becomes more affordable, it literally takes a couple of years for the market to adapt to, well, wait a minute, I can purchase this home at this price, I can sell my home at this price. And after a couple of years, and we had about an 11-year stint where interest rates never went above 5.5%. The result? Home prices have gone up. Have you seen home prices go up in your area? I know I've seen them go up in my area. And it's clear to see that as they've raised interest rates, we've seen a slowing of big ticket items such as boats, motorhomes, houses, and RVs. But think about this. It's not just that people are reluctant to buy something because it maybe cost a little bit more. Unfortunately, people are priced out of the market to even afford a home. You see, a $275,000 home today at the interest rate of 7% is $595 more than that same house would have cost you 18 months ago when the rates were 3.5%. And yes, it's true, prices are coming down on exaggerated priced houses. And the ones that don't make adjustments on the market are staying on the market much longer. So back to the things that can keep you broke. Your vehicle. We all just need dependable transportation. Unfortunately, so many of us, me included, fall into the trap of having a vehicle connected to our status. We're constantly looking at our outward self and what other people think about us. If we're driving a vehicle, it's just a base model vehicle, we can't help but think, oh, what is that person thinking of me? That, however, can hold you back dramatically in life. There's a term in real estate called being house poor. You don't want to be house poor, but you also don't want to be payment poor, meaning a payment for a four-wheeler, a payment for a vehicle, payment for a boat, because you'll be strapped monthly to those payments and you can't afford to do anything else. And look, you've probably heard people like Robert Kiyosaki and Dave Ramsey and Wayne Turner say things such as that. And yes, my name is Wayne Turner. If you hadn't done so already, subscribe to our channel. This is good stuff. Now, it's so much easier to become payment poor when it comes to large ticket items such as those boats, motorhomes, and RVs. And here's the reason why. Because when you go to purchase one of those vehicles, they pull your credit, but they do not verify your income. You've probably purchased an item like that and you fill out an application and they ask you what your income is, but they don't verify your income. They'll pull your credit, and oftentimes they're not even pulling what they call a tri-merge credit report, where they pull Experian, Equifax, and TransUnion. And they'll also take your highest credit score out of the three. So they're not verifying your income, and if you rent, they can't verify what you're actually paying in rent. You see, if they ask you if you own a home and you say yes you do and you put down the payment, well, when they pull your credit report, more than likely they're going to see that you actually owe a mortgage company a certain amount of money plus the monthly payment. Now, depending on the finance company, they may ask to see your actual creditors, but most of them can pull your full credit report and see every single thing that you pay on a monthly basis. They can also see your credit score. However, as mentioned, they cannot verify your income. So whatever income you put on that application, they're not really looking at the income. All they know is if you have a 580 credit score or 670 credit score, whatever that threshold may be, to allow you to purchase whatever item it is you want to purchase. Do you see where I'm going with this? Do you see how easily it could be for someone to get kind of behind the eight ball, if you will, financially, because there's no verification of income. They're only looking at your credit score. Now, if you have a credit score that's below average, you can still purchase that item that you're looking to purchase. However, you're going to be getting what they call a subprime loan. It's not going to be the prime rate, and therefore you're going to have to pay a higher interest rate on the money that you're borrowing to purchase the item. Now, the reason that financial institutions say they must charge you a higher rate is because you're at a higher risk, meaning that if your credit score is lower, there's a higher risk statistically of them having to repossess whatever it is you're purchasing, car, boat, RV, motorhome. As mentioned, business is looking to boom for the repo companies because of the storm that's brewing for the auto loan industry. At the North American Repossessors Conference in Orlando, Florida, one of their main topics was filling the demand for having to repossess vehicles and having the people to help them do it. Now look, I get it. These people are paid to do a job. You can't get mad at them. It's just like buying a house or renting an apartment. If you don't pay, you don't stay. If you don't pay, you can't drive it. And that's why I always say, get your money right, get your credit right, you'll sleep good every night. So what can you do to fix your credit, to fix your bruised credit? I'm glad you asked. I did a video on that. I'm going to put a link below. And it will basically show you really quickly how to bump your credit score as high as 100 points in a matter of about 45 days. Listen, it's so important to know when your credit score is around 700 or higher, at that point, you're doing the banks a favor by allowing them to loan you money. Remember that $48,000 vehicle paid over 69 months? You're going to pay $9,655 over the 69 months. That's the interest that you actually pay the bank. That's a lot of money. But you want to hear another interesting fact? Get this. The IRS says that if you actually own a business and your vehicle weighs over 6,000 pounds, you can deduct the entire cost of that vehicle in the first year that you own it. So this is how it works. You own a business, you have an LLC, you show proof that you're making money, you have income, whatever that business may be, and if your vehicle weighs over 6,000 pounds and you use the vehicle 50% or more for the use of your LLC, the use of your business, you can purchase that vehicle and write the entire amount off the first year. It's called Section 179 of the IRS tax code. Now listen, I'm not a CPA and I'm not a tax attorney, but I've personally done this, and it saved me when I purchased my vehicle through my company that weighed over 6,000 pounds. It saved me $13,000 off my taxes. So look, one of the most important things you can do for yourself is to simply figure out what your monthly payment is going to be and what you're comfortable paying. Don't just walk into anywhere and think, I'm comfortable with my payment at $300 a month. You can simply go to Google and type in automobile payment calculator or mortgage payment calculator. You can put in the amount, you can put in the interest rate, which is around 7% right now with average credit, whether you're buying a vehicle, a four-wheeler, a boat, or a house, and it will show you what your monthly payment's going to be. It's always best to be prepared.